Welcome to this Killik Explains finance video. This week, a big topic, what's behind 2018 stock market mood swings? Now the question that investors want answered is, and will they continue? Well, that one's much harder to answer. I don't have a crystal ball, neither does anybody else, but we can look back and say, what do we think has caused these volatility spikes, and therefore, are we likely to see more in 2018? Twist answer is yes, probably, so what should you do about it? Let's cover all that here. So first of all change. Now why have I called the first section all change? Well, basically, you can look at how markets have changed 2017 to 2018 using a number of measures. I've chosen to go for a couple. One of them's on this slide. You can look at the stock market itself. So the S&P 500 in the world's largest economy, and the FTSE 100 over here, just to show that it's not just America. When America sneezes, we tend to catch a cold and so on. So there you have it. A reasonably smooth trend in 2017, reasonably smooth trend, all right, not spectacular growth, but reasonably smooth, and then bang and bang. So first quarter of 2018, suddenly the wheels came off, big dip in February, markets have been more volatile ever since, albeit they've recovered some ground. You can look at it another way, for confirmation if you like. So here are the volatility indices for the US, known as the VIX, and there is a FTSE equivalent in the UK called the VFTSE. And again, reasonably calm in 2017, and suddenly wallop, there you go, February that was, that big spike there. And the same in the UK, reasonably stable, and then bang. All right, so evidence of this volatility spike is kind of everywhere. You can find it in the bond markets and so on. Now, question is what's going on? So at the heart it's this, investors hate uncertainty. So how much uncertainty has there been in 2018? Arguably compared to 2017, the answer is there has been a bit of a step up. Where? Well, let's take a look at that. So key factors. Two of them are related to that uncertainty point, and a third is slightly more technical. It's about the nature of the stock market itself, and that's important too. So monetary policy is changing. Now you can say, well, that wasn't new. That wasn't like Christmas thing, the world didn't change. No, but the direction of travel is now clearer, and investors are starting to get nervous about it and what it means. Number two, geopolitical instability is rising. Now, it wasn't like it suddenly appeared at Christmas, if you like, but nonetheless, 2018, plenty of reasons for investors to worry across the globe and across some major power bases, as I'll explain in a moment. And then the technical factor. So put those two together, shove them into the stock market, and you've also got this third factor, which I call inexperience meets automation. I'll come back to that one in a moment. That exacerbates, if you like, some of the worry that come from bubbles 1 and 2 here. So let's have a look at those in turn. Now I cover this in a lot more detail in other videos, so this will be short and sharp. Monetary policy, that change in monetary policy. So there are two slices to this, if you like. So central banks are starting to change tack, led by America. All right, so they're not all changing tack at the same speed, even at the same time, in the same way. Led by America, the Federal Reserve has started raising interest rates. Right? And the direction of travel is reasonably clearly signposted now for the time being. The Bank of England has followed suit. Other central banks haven't done in fairness. Bank of England, a little bit behind, one could say, but has followed suit. And whilst the rises today have been modest, particularly if you're looking at the Bank of England, for example, they follow a hugely long period of record low, close to zero interest rates. So investors are suddenly, it seems, starting to absorb and ponder the implications of those rising rates for global asset prices and so on. QE, now that was the extra stimulus post-financial crisis introduced by central banks. So this is, broadly speaking, money printing. Cover this in more detail in other videos, so keep it short here. So taking bonds out of the market, IOUs, putting money back in, if you want to see it that way, creating that extra liquidity, and that's acted as a lovely cushion underneath asset prices for about a decade, if you like. So in the US, the Fed's the most aggressive. The Fed said, right, we are not just going to slow QE, we're not even going to just stop it, we're actually going to put it into reverse gear. The Bank of England, slightly behind them, if you like, and other central banks just at the stage of slowing down QE, let alone tightening. But the point is, the direction of travel around the world appears to be clear, and usually where the US leads, eventually everyone else follows. So, what's that all about? How's that work? Very quick reminder, QE is where you get central banks injecting liquidity into the system. I've called it cash, electronic liquidity, withdrawing IOUs via the big institutions like pension funds. All right, so you get IOUs coming out of the market, if you like, injections of liquidity going back in. Impact, That reduces the pool of bonds and creates extra liquidity, which finds its way out into asset prices and so on. The result, higher prices and record low yields. In the bond market, we've seen borrowing costs crush to a record low level. So the worry investors have is if central banks start turning the handle back and reversing this, what's going to happen next? Now, no one actually knows the answer. The Federal Reserve said, don't worry, it'll be done smoothly, don't need to panic. But nonetheless, investors are sort of asking themselves, how smoothly can this QT be done? You know, rising bond yields will affect borrowing costs. Why rising bond yields? Well, if you think about it, if bonds basically are introduced back into the market, that will depress prices and push up yields. You want to see it that way. So people are getting nervous about that one. How does that affect geared positions and so on? Risk a snapback. So in other words, if the bonds market panic, if they have a tantrum, which they've been known to do in the past, the implications could be fairly severe, and asset prices may get hit hard as confidence evaporates. In other words, as yields start rising, we haven't been used to that for a while, investors might start getting nervous about the ripple effects in terms of the global economy. Geopolitics. Now, this isn't helping. So you've got the Trump factor, first of all. So in the US, talk of a possible trade war with China has unnerved investors, all right? Simple reason that the bilateral trading relationship between the US and China is massive, arguably the most important trading relationship in the world at the moment. So any talk of either country retrenching, imposing tariffs, trade wars, naturally markets get nervous about. There's a new harder line with nuclear North Korea. So America's the biggest nuclear power in the world. North Korea is certainly probably the maddest nuclear power in the world. Put those two in a room and who knows what's going to happen. Russian relations have been frayed over Syria and Salisbury. You know, Russia increasingly wondering what its role in the world is. With the rise of China, America is already the biggest economy in the world. So one could say almost looking to start a fight, perhaps. So we've had relations frayed over Syria, the Salisbury poisoning and so on. There are fears of regulatory crackdown. That's a slightly different point. So we've seen Mark Zuckerberg in the dock with Facebook. We've seen Trump rumbling about going after Jeff Bezos at Amazon. So suddenly the tech titans, the golden boys, if I can call it that, of the stock market under threat, under regulatory attack. And then we've got the hard line on Iran and the possible implications for oil prices. So plenty to worry about. Elsewhere, well, the UK and Europe have still not sorted out their post-Brexit position in the customs union, not in the customs union. So investors got that to worry about. We've got the rise of populism. That hasn't gone away. Populist movements everywhere in the UK, Spain and Italy. Or I've even heard talk of Yorkshire breaking away from the UK, for example. Iran, recent protests, leaving aside Trump's position on Iran, were some of the biggest they've seen recently. And on top of that, you've got the Trump intervention there as well. Combining all those factors together in the Middle East, we've seen the oil price spike above $75 a barrel. Now, historically, it's been higher, but that's a big climb up from 30 to 40 not so long ago. So, plenty there for investors to worry about. Now, the third factor is this, inbuilt instability. This is like not the cause, it's almost like a symptom if you want to see it that way, but if you put all that together, I would argue, people have argued this before, but I would argue that the structure of the stock market has changed slightly, and that makes these volatility spikes slightly more aggressive than they might otherwise be. I don't think these factors cause it per se, but they can exacerbate it. So what do I mean by that? Rise of the robots. What I'm saying there. So a long bull market has drawn investors into a market who are inexperienced in volatility. In other words, someone who came into the market 10 years ago has just seen it rise, basically. A long bull trend. Suddenly, what's going on? Markets are volatile. Stock market dropped heavily in February. What's happening? People are not used to dealing with that. Some long-term investors are, but there are people out there who are not. So that increases the risk of a panic when markets dip. And the point is, robots make it very quick and simple to dump stocks at speed in multiple locations. So I don't think high frequency trading or algorithmic trading or computer-based trading are the underlying cause of volatility and sell-offs necessarily, but boy, can they accelerate the impact when it happens. So that's my point. And now you've also got this whole new asset class based around volatility and lots of ways of betting on it. So as the market gets more sophisticated or more dangerous, depending on your perspective, people now bet on volatility itself. So if you think markets will or won't spike, you don't have to just bet on shares or bonds. You can bet on the actual indices like the VIX. So there are derivative-based products, futures, for example, that bet on volatility itself. Then you've got the exchange-traded notes. These are tracker products. A couple of big ones collapsed in February and were actually withdrawn from the market. And what we're seeing is that this is a new market. People don't always understand what they're buying. A lot of people who bought those ETNs had no idea how the price would collapse if things went wrong. And therefore, it's quite a dangerous mix. You take inexperience with basically these new, relatively misunderstood products, and you've got a potentially dangerous cocktail when the market does head south. So as I say, not the cause, arguably, but certainly something that exacerbates the problem. The bottom line then, what are you supposed to do with all this worry as an investor? Well, first of all, accept it. Volatility is part of equity investing. Sudden, sharp sell-offs are part and parcel of investing. And I don't have a crystal ball. We'll probably see more in 2018. The economic data is actually quite supportive. All right, so the good news is that yes, commodity prices are rising and so on, but actually the global and US economy in particular don't look to be in too bad a shape. And dips, therefore, can be seen as an opportunity as much as they are a threat. Depends on having the right mindset. Keep it simple. So obviously, common sense. Avoid anything that sounds like a volatility-based product unless you know exactly what you're doing, and even then be very careful. So new sexy products, usually a bad thing. Make sure you're positioned to ride out volatile periods in terms of your portfolio cash allocation and so on. Don't let the headlines lead your approach. So yes, you'll see headlines about whether algorithmic trading, CBT, is responsible for these crashes. Ignore all that, it's kind of noise, right? It's peripheral. Diversify and rebalance. So make sure you are geographically diversified, and also make sure you're rebalancing if any of these volatility spikes skews your portfolio too much in one direction or another. Okay, covered a lot of ground there. Any questions, and there may be a few, do email me at the usual place, editor@killik.com. And if you'd like to see videos on some of the topics I've covered here in more detail, then as usual, killik.com/learn.